Global stocks are mostly down these days as concerns over global growth re-emerged amid as a prolonged inversion in the U.S. Treasury yield curve. The benchmark 10-year Treasury yield slid on Wednesday, but came off 15-month lows reached a day earlier. As a reminder, the yield curve inverted for the first time since 2007 on Friday, which is seen as an indicator of the impending recession. Investors are also worried by central banks' dovishness across the globe. Last week, the Federal Reserve did a stunning about-turn on rate hikes, while the ECB became the latest central bank to delay a planned increase in rates amid rising threats to growth. Dismal factory data from the United States, Europe, and Japan add to market concerns as well. On Wednesday, European stocks were grinding lower, while U.S. indices bounced off lows but still traded in negative territory, with healthcare and utilities shares weighed on the market. Besides, sentiment remains sensitive to signs of slowing global growth. As for geopolitics, a new round of U.S.-China trade talks is due to kick off in Beijing on Thursday. Investors hope that the relationship between the two countries will finally be rebalanced and the trade deal will be made at some point later. Trump said last week that he plans to keep tariffs on Chinese products until he's sure Beijing is complying with any deal, citing concern that it hasn't lived up to previous commitments. On Tuesday, the U.S. president told Republican lawmakers that he won't settle for less than an excellent deal with China. The uncertainty on this front makes investors nervous as well, though optimism seems to be prevailing now. Meanwhile, in the UK, the Prime Minister Theresa May has said that she will step down if her Brexit deal is approved by Parliament. Lots of switching Tory MPs, including Boris Johnson, are now coming over to back Theresa May's deal. Britain was due to leave the European Union on March 29th, but has been granted a delay until April 12th after Parliament overwhelmingly rejected May's agreement on 2 occasions. The pound jumped on the headlines and registered a one-week high around 1.3270 and then settled marginally lower. The pair will continue to trade in a volatile manner with a focus on fresh Brexit developments. As for other currencies, the euro-US dollar was lower again on Wednesday as buyers struggled to push the pair above 1.13. The single currency refreshed 2-week lows around 1.1240 amid the risk aversion and a stronger dollar. Mario Draghi said on Wednesday that the European Central Bank is ready to soften the impact of negative interest rates if they are found to harm the transmission of its monetary policy. He also highlighted that the central bank could further postpone a plan to raise Eurozone borrowing costs if data continue to show contraction in the region. This comment sent the euro down marginally. On the data front, the U.S. trade deficit dropped more than expected in January as China boosted purchases of soybeans, leading to a rebound in exports after 3 straight monthly declines. The trade deficit declined 14.6%, which is the largest decline since March 2018, to $51.1 billion. Moreover, data for December was revised slightly down to show the trade gap widening to $59.9 billion instead of the previously reported $59.8 billion. The politically sensitive trade deficit with China fell 6.4% to $34.5 billion in January. However, the deficit remains elevated anyway, and many other reports, including manufacturing and home building data, suggest the U.S. economy is losing steam in the first quarter. This in turn warrants further patience from the Fed in terms of hiking rates. In commodities, crude oil prices fell slightly after the Energy Information Administration reported a moderate build in U.S. crude oil inventories for the week to March 22nd. These added 2.8 million barrels in the period, the EIA had said. A week earlier, the EIA reported a draw of 9.6 million barrels. In general, optimism about a U.S.-China trade deal, OPEC cuts, and the U.S. sanctions on Iran and Venezuela continues to dominate market headlines, along with the persistent concerns over the world's economic growth prospects. Technically, Brent still struggles to regain the $68 level, standing on the way to the $70 threshold. However, positive news in the trade talks could push the prices higher, along with other risky assets. On the downside, the important support area lies around $66. Gold prices extended losses on Wednesday, with much of the pullback being due to stronger dollar that remains attractive in times of stress in the global financial markets. The bullion pulls back from the monthly high of $1,324 registered on Monday, with prices reaching a 5-day low at $1,308 on Wednesday. A break below the $1,310 figure is a negative technical signal, but as long as the precious metal remains above the $1,300 threshold, the downside risks remain limited. In the days to come, global investors will focus on the U.S.-China trade talks, Brexit news, as well as important economic data from the major economies, including the U.S. GDP, German CPI, UK GDP, and the personal income/spending in the U.S. So that is all for today. Thank you so much for watching, and please click subscribe to always be in touch with the latest market news.